morning. I'm Mohini Naidu, and for this next segment, we will hear from Stephen Romick, co-portfolio manager of the Ned Group Investments Global Flexible Fund. Steve will talk to recent fund performance and positioning, which will be followed by a Q&A session in which we will gain more insights into the team's thinking. Steve, a very warm welcome, and over to you.
Thank you, Mohini, and thank you everyone for taking the time to listen today. We at First Pacific Advisors and our Contrarian Value Management team appreciate the long partnership that we've had with Ned Group and its clients. The Global Flex Fund declined 4.7% in this year's third quarter and has declined 16.4% in the last 12 months, protecting capital better and outperforming its performance indicator and the MCI world in both periods, as shown on this table. The markets remain volatile as investors continue to grapple with higher levels of interest rates and inflation that we haven't seen in 4 decades. Having higher input and borrowing costs without the ability to pass them through in the form of higher prices has been a problem for many companies as economies have weakened. The big question, of course, is how bad can this get? While we don't know the answer, we are comfortable saying that a portfolio of reasonably priced, higher quality businesses should perform well over time. In the trailing 12 months, Global Flex's top 5 performers contributed 1.4% to its return, while its bottom 5 detracted 7.3%. The longer time frame is more relevant and where I'd like you to focus. While even stock price movement over a year can prove temporary up or down, quarterly moves can be even less relevant. In the prior quarter, we spoke of Comcast and Charter, cable companies, and Glencore. So in this quarter, we're going to focus, on a few others and highlight them that you see on these companies you see on this page at the bottom. Swire Pacific announced a value-creating share buyback, and its shares rallied. The underlying business is cheap, but worse than it was a few years back due to the complicated Hong Kong-China relationship. LPL Financial has benefited from higher short-term interest rates and continued strong asset flows from its clients. There's nothing new on PG&E, which is a California-based utility that's been delivering on expectations. Its stock price at one point had gone down because of fires and concerns about liability, and has benefited more recently from not being responsible for any fires in the state thus far into what we call here in California our fire season. Diving deeper into Meta and Alphabet than what's been well documented in the press would take longer than we have today. Both businesses have excellent franchises. The world has very little conviction in Meta, though, today, formerly Facebook, which has caused it to trade at very low teens multiple net of cash. We have more conviction in Alphabet's franchise, which, though more expensive than Meta, is still reasonably priced in our view for the growth we expect to see in the coming years. That would explain why Alphabet is a larger position in the fund than Meta. It's difficult, candidly, to fathom why Citigroup trades as it does. Trading at 55% of its tangible book value, it's cheaper than it has been in more than a decade. Its price is if the world is expecting another great financial crisis. And if so, then one could reasonably argue that the rest of the market would be overpriced. Global Flex has net exposure at the end of the third quarter of 68.4%. Marginally lower than the 69.4% exposure at the end of the second quarter. While exposure is lower, that's really more noise than anything else. And importantly, given that stocks have declined as much as they have, this small decline in exposure does not reflect the greater activity when you scratch below the surface, including having added 6 new positions during the quarter. Bonds continue to increase as a percentage of the portfolio, and we hope to own more still. We've been spending a lot of time on higher yielding convertible bonds in the tech sector, many of which have seen investor capitulation and low double-digit yields with little to no value ascribed to the convertible option that exists as part of that convertible bond. The fund's asset allocation composition hasn't changed much since Q1. Financials and technology, which falls in both the information technology and communication services category, continue to be our largest sector exposures. We want to own good businesses at good to great valuations, and we'll end up in whatever locale offers that. So when you look on this slide of equity geographic composition, you'll note that we have, currently, and excluding the SPAC position, we have almost 38% of the fund's invested exposure is domiciled outside the United States. And more relevantly, in our view, about 55% of the look-through revenues are derived from outside the United States. The greatest weakness year to date has been in growth stocks. The S&P 500 Value Index has been the best performing index in the past 9 months, declining a lower 16.6%. Ned Group's Global Flex is just behind that, declining 18.2%, outperforming these other indices you see on this page. Value stocks have benefited from the energy sector, being one of the few bright lights in the market. Now, despite energy's strong performance in 2021 and 2022, the S&P Energy ETF, the XLE, increased 55% in the last year. Yet the sector's dramatically, even with that, underperformed over the last decade. Our preference is to own higher quality businesses with higher returns on capital and better management teams. And we have scoured, the energy space, and it's something we continue to do work on. So I'm not going to, never say never. We've owned it in the past, but again, it's finding that best combination of price and management quality, where the capital allocation decisions are stronger. So the return on capital, that we need to see will hopefully show up in one of those businesses that one day might be in the portfolio. Growth stocks have been the greatest drag on stock indices. The worst performers, which we've largely avoided, have been the many money-losing companies with unproven business models. The most expensive stocks, have declined the most. This chart shows the year-to-date performance of the most expensive 10% of the S&P 500 as compared to the remaining 90%, using price to sales as the valuation measure. The top decile in valuation has declined 31% in the last 9 months, while the remaining 90% have declined a far less, average of around 18.5%. While the most expensive have become less so, they are still far from cheap, as exhibited in the table at the bottom of the page. At the end of September, the top 10% traded about 38 times earnings, down from 68 times. The remaining 90% traded at an easier to stomach 17 times earnings. Market valuations have moved more in line. In equities, more traditional value stocks are no longer as inexpensive, as reflected in this chart. Unlike March of 2020, when value spreads, which is the cheapest 20% of the market versus the market average, got to 2008 levels of cheapness. The spikes in this chart reflect valuation disparities in the market and tend to be good places in which to focus our attention. With stocks generally trading more in line today, that is, without a major spike, as you can see to the far right of this chart, we've been spending more time considering and adding to faster growing, better quality businesses, many of which are both less expensive than the market today and where they've historically been valued. International stocks remain cheaper than US stocks, and the companies outside the US trade less expensively, and that's supported by this chart that reflects that international stocks traded at 29% discount on average to forward earnings when compared to US stocks. Of course, this chart does not take into account quality and growth differentials when contrasting companies based in the, when looking at companies based in the US versus other regions. We are often asked about, our outlook, which is kind of funny considering we've never made a market forecast. And like everyone else, we are regularly surprised by world events. While there's plenty to worry about, we agree with Jamie Dimon, who on JP Morgan's second quarter call this year, in response to a question about pending economic hurricanes, observed that going through a storm that gives us opportunities, I always remind myself, the economy will be a lot bigger in 10 years, and we're here to serve our clients through thick and thin. There will always be a place in our portfolio for good businesses at good prices, and you will see the fund's risk exposure increase should those prices become great. As always, we will be conservative in our underwriting and let price be our guide. And despite our no prediction philosophy, we do think it's useful to observe current market conditions and pricing for financial assets in order to avoid potholes, focus our research attention, and calibrate our own risk appetite. In bonds, we mentioned the initial fruits of our labor in convertible bonds. Now, stepping back, we would observe that high yield is approaching 2016 and 2020 yield levels, where credit spreads are still below the 800 basis point spread seen in both those periods, despite there being no official recession in 2016. Thank you. That's the end of my prepared remarks. I'm going to turn it back to Ned Group and Mahini for some Q&A.
Thank you very much for those comments and updates, Steve. So let's jump right into it. Now, with most global markets and sectors in negative territory for the last year, which opportunities do you and the team find offering the most value today, both in terms of region and capital structure? And does the strong dollar, I think the dollar is at the strongest level versus the pound for something like 2 or 3 decades, does this actually impact your geographic allocation at all?
If you go back to the slide that and think about the one I posed or showed earlier, which says 55% of our revenues come from outside of the United States. And so when we think about, currency, for example, to start with that part of the question, we have a global portfolio of lots of different businesses that operate in different regions of the world, whose sales and earnings come in different earnings and balance sheets that are valued in different currencies, and his balance sheets are also valued in these different currencies. And what's difficult from where we sit as investors is diving into A, trying to make a decision as to what exposure you really want, and B, knowing that if you don't want a certain exposure, how to wanting to absorb the cost of hedging that, and then potentially hedging a hedger, because many of these companies actually hedge their currencies themselves. So it's actually quite complicated. And so what we try and do is really try to avoid those be mindful of those areas where we think currencies are have the greatest risk, which was a point in time in the past where we were very mindful of Russia and looking at ruble-based exposures, in which we didn't want. So at a point a number of years ago when we had energy companies in Russia, we weren't as concerned because their revenues were priced in dollar terms, and that they were priced in petrodollars. And so those are the types of risk we're willing to accept, invest in different countries if we have some protection that we see through to the income statement, which was the case in those dollar-denominated revenues that Russia was getting. That's not the case today, because we don't have any exposure in Russia directly. I mean, some companies, will do business there, obviously, but we are mindful of the exposures across our portfolio and where the risk is. But we don't know whether the pound's going to be stronger than the dollar in the coming 12 months, or the euro will be stronger than the pound and the dollar. So we have this portfolio, that will fluctuate along with various currencies. But one other part of the question I think is really important and worth dwelling on is the capital structure. And the capital structure, question is important because we want to make sure the companies that we own have that staying power, to be around in over the next 5-10 years. And sometimes you can have a good business and a bad balance sheet, and the bad balance sheet, can trump the good business in those periods of extreme duress that comes from economic weakness or industry specific weakness, as the case may be. And so we are mindful of trying to stay away from those businesses that have excess leverage, because that excess leverage, that debt will have to be paid back. That debt might, have to be refinanced, a portion of it, in coming years at higher rates, and some of the debt might be floating, which as rates go up, those companies will have to pay more in interest costs. And so those are variables that we do actively consider. But when you look at it in the aggregate, it's more about trying to stay away from certain things than driving us towards other things. So it's trying to avoid, this risk that is very hard to assess in terms of what the currency might be if it's a third world country, and how that might do, or having an excessive leverage on a balance sheet. So those are the kinds of things that we seek to avoid.
Thank you. If we look at it from a more granular point of view, looking at Amazon, for instance, and other tech names that you were buying about a year ago. Now, since then, this sector has fallen about 30 to 40%, yet you haven't added to these positions. Is this because of a decline in the fundamentals of the sector and these particular stocks that you took these positions in?
Well, the whole world's re-rated, and many of these companies are, that we've added certain other tech-related names, to the portfolio. We've had the tech-related exposure to the convertible bonds, but as long as this market has declined, we've also seen other opportunities in other businesses that are down, similar amounts. So it's not, a negative statement about if we don't add to a company, it's not necessarily a statement that we no longer like that business, but we might see other better opportunities to allocate capital around the world.
Thanks, Steve. Now, you've spoken to high yield briefly in your presentation. Brian spoke about high yield spreads widening out in 2016 and one or two other periods since then, but that these opportunities there was a very narrow window of opportunity which closed before you were able to act. Now, do you think that this puts you at a disadvantage against dedicated credit managers? And if so, what do you think could be done to help mitigate this?
Well, it's an interesting question because I think the answer to that question is yes and no. I think it's inarguable that a high yield manager that runs a portfolio dedicated to high yield bonds that's in the market every day. When the market's in duress, they'll be active. They're more likely to be active buyers more quickly than us. So if the market is only down for the briefest of moments, they will allocate more capital probably at that moment in time. But the reason why I say yes and no is that those same managers are dedicated, to high yield. And so they've already gone down with the high yield market, leading up to that point. So the fact that they're buying when the market is at a low, probably also means, more than likely they're buying at higher levels as well. And so what we don't end up putting to work relative to somebody else, they're just adding more to their dollar cost averaging and bringing their portfolios down to the extent that they have that capital, to reallocate. It's interesting because government involvement has short-circuited the economic cycles. We don't have the depth of recessions because in recent years because of government stepping up and printing a lot of money and driving rates to very low levels. And even with this massive rise in rates that we've seen today, we're still operating at negative interest rates, negative real rates. And so this is not the most hawkish of environments, certainly. What we expect and hope to see at some point in time, I mean, be careful what one wishes for, is that we see higher yields today, but spreads are still far from where they've been at their historic widest, and they're not, even though they're slightly above average. But we do expect that this cycle will not be over till we've seen, some credit events, within some of these companies that, as I mentioned earlier, have too much leverage that will have to be refinanced, at a point in time, or have too much leverage that that's floating rate debt. It's got to pay higher interest costs, and so we're going to see some restructures. I would expect and hope, and some of those will create opportunities prospectively. But if the market is down for just the briefest of moments, as it was in Q1 of 2020, when government stepped up and started buying bonds and giving money to corporations and individuals to help shore up the economy in the U.S. and happened in other parts of the world as well. If it happens like that, then no, we're not going to see that opportunity. But I don't think that the government's continue to manage this, these economies ad infinitum in the way that they have. And I think there will be moments in time where things will break. It always has happened in history. It'll happen again. The only question is when.
Steve, this has felt like something of a roller coaster year for investors and I'm sure portfolio managers alike. Can you maybe share with us in very briefly, what does a typical day look like for you and the team at the office right now?
The day looks the same as it always has, whether the market's volatile, going up and down or remaining flat for an extended period of time. Our days are the same. We're trying to understand the best businesses, that exist around the world. And, we just dive into the research on those companies, talking to management teams and doing a lot of reading. So it's just the only difference today is just putting more capital to work at points in time, adding more new names, given price action. Other than that, it's more of the same.
Thank you very much, Steve. Thanks for taking the time to be here again today and for sharing those valuable insights with us. And I, for one, as an investor in the fund, do find some reassurance by your philosophy and process of looking to firstly protect capital for investors protect investors against a permanent loss of capital while still looking to actively participate in market upside. Steve, thanks very much to you and the team. Take care.
Thank you.